Welcome to the American Enterprise Institute. I'm Tom Miller. Our event today is getting beyond employer-sponsored health insurance, at least maybe this time. It's been said and attempted in the past, and there have been some fits and starts in making that come about. A little bit more of an evolutionary process ahead. I've lost count of the number of predictions and forecasts going back a decade or two in terms of, if not the end, the decline and fall of employer-sponsored insurance. Yet it's still around and doing better than might have been forecast a few years ago. After the Affordable Care Act, it turns out that employers are not, quickly taking the advantage to drop coverage. Not growing a lot. The growth has been more in Medicaid, primarily in terms of the coverage gains and fewer uninsured. But in terms of the employer-sponsored insurance front, looking ahead, there are continuing challenges and questions in terms of future regulatory burdens, which can become even greater looking ahead. We've had a cycle of slower growth in healthcare costs and spending in general, but employer-sponsored coverage is more likely to start growing faster in terms of its expense than some of the other types of coverage suppressed by both regulation and subsidies. And there are other burdens ahead. A little bit of an open question as to where the Cadillac tax may be going in a couple of years, but employers certainly need to take that into account. So if you're an employer involved in this, and it depends upon where you are in the sphere, whether you're large, mid-sized, or small, and different perspectives there. There's still efforts to look to improve, in some cases evolve into slightly different set of arrangements, or just cope with what is incoming. And there are a lot of goals of the past that have other approaches to try to achieve them in the future. Efforts to have a little bit more consumerism in healthcare, more choice, portability, personalized options, reducing some of the back office expenses in administering and carrying out a health benefits program. So perhaps freeing employers to some extent from what is not their core business, and also a little bit more possibility of budgetary certainty in what's going ahead. It's more likely than not, though, that we're talking about various types of hybrids rather than one single form or another. So what we're going to proceed, how we're going to proceed today is there are 3 or 4 main areas we want to highlight initially. What we know and don't know, and what might be ahead for what are described as, and they vary in different degrees, private exchanges. How all these different options might be regulated in the future, whether the different terrain requires a different regulatory approach or more of the same. How to carry out perhaps a defined contribution type approach to financing of health benefits for employers, but what they come up against in terms of being able to carry that out with the existing regulatory and subsidy grid. And also for employers who are not looking to get out of the game but want to do something different and better, whether a reformulated type of employer alliance beyond just the old style purchasing just to get a few cost savings here and there, how that might come about. So we have 4 excellent speakers today with background across the board, but we'll start off with them talking for a little brief overview in each of these territories, somewhat of a best of as to what they would suggest bringing to the table and how to think about it. And then we'll have a little bit more of a round table discussion, somewhat congressional hearing style, where I have all the proxies of the members so no one else gets to ask a question for a period of time. With that, though, we're going to start off with Chris Condalucci, who is principal and sole shareholder of CC Law and Policy PLLC in Washington, D.C., so he never has to disagree with his partners because they all agree with him. That's true. That's internal dissent. That's right. His practice focuses on his background in the Affordable Care Act and its impact on stakeholders. Many of you know that Chris was quite involved for a number of years on Capitol Hill, primarily as a tax and benefits counsel to the Senate Finance Committee, in the midst of which the Affordable Care Act, kicking and screaming, was finally passed and shot out the door. So his current practice talks about a lot of the what we've learned from the ACA, what can be done with it. And I guess you're also responsible for all the new taxes enacted under the law. Is that right?
Not responsible, but certainly involved.
All right. Well, we won't take the blame on that one. What Chris is
Taken
going
my
to
lumps before.
what Chris is going to focus on primarily in his opening remarks, and then I'll introduce our following speakers, is the evolution of private exchanges. We know a lot about public exchanges, but private exchanges are a different platform and face for a different approach for employer-sponsored benefits. Chris?
All right, well, thank you. I want to time myself here. So thank you, Tom. Thanks to AI for having me, and thanks everyone for being here. Really, there's a lot of places to start, right, when talking about private exchange, when talking about employer-sponsored insurance. What I just really wanted to do, respecting the idea of the best of, I really wanted to start from talking from an historical perspective. So if you are in the private exchange space, you kind of know this. If you're new to the private exchange area, you might not know this, and that is private exchanges were in existence before the ACA was enacted. So to an extent, private exchanges aren't a product of the ACA. They were certainly, interest was accelerated on account of the enactment of the ACA, but certainly not a product. So it's important to know that private exchanges have been in existence. And also even going further back than just 2010, the idea of a marketplace through which insurance can be sold has been around for decades. It was discussed in the early 90s during the Clinton healthcare reform exercise. As many may know, the Heritage Foundation put together a template that most folks looked at as a marketplace, and many observers argue that that was given to the Romney administration in Massachusetts, and that served as the template for the Massachusetts Connector at the time. Then when folks were drafting the ACA, and as Tom indicated, I happened to be a part of that on the Republican side. The Republican staff and the Democratic staff worked very closely together from January of 2009 to September of 2009. So again, I take my lumps for being part of that process, but I can't shy away from being a part of that process. And I mention my time on finance to say this. Early on in the drafting process, we actually looked at private exchanges as a model for the ACA exchanges. And again, dare I say it, but private exchanges and the ACA exchanges are somewhat similar in that at their core, they're this distribution channel through which health insurance can be sold. Now, where private exchanges and the ACA exchanges kind of diverge is the manner in which they're regulated. You know, the ACA exchanges, as we all know, have thousands of pages of regulation, whereas in the private exchange space, and we'll talk about this in a little bit with Mark as well as others on the panel, private exchanges that is, are generally governed by the state insurance, agent and broker laws, tax law, ERISA, just existing law that has been in place for a while. Some ACA stuff, but not significantly compared to like the ACA exchanges. So again, I don't want to get off topic, but the point of the matter is, historically speaking, private exchanges have been around. The idea of a marketplace has been around. Private exchanges were looked as a model early on in the drafting process. Politics are politics, and we now have the ACA exchanges. So now, post-ACA, right? And again, I said, private exchanges were not a product of the ACA. But because of the ACA, there was accelerated interest in private exchanges. Because again, this marketplace concept was finally put into the law in the form of an ACA exchange. So people said, well, there's these private exchanges, work kind of similar, at least to this distribution channel. Let's look at these kind of platforms, electronic platforms through which you can plug your employees in and allow them to shop for coverage. So again, the interest has accelerated. We're going to talk a little bit about the fact that the interest has waned a bit, and I'll table that for the larger discussion to move in to say this. Tom brought up the word consumerism, and I personally am a fan of consumerism. I'm sure many folks in the room are consumerism fans, and in my opinion, as others share this opinion, private exchanges really are a tool to promote consumerism. And really there's three features of a private exchange that I think, let's say, promotes or allows one to meet the policy goal of trying to promote that consumerism. And Tom touched on a couple of them. One is the expanded employee choice, because there are a number of health plans that employees are able to access through a private exchange, and it's displayed in an organized fashion. Then there's a decision support system, which has education tools, which has tools that help a employee who is a consumer make the right choice when it comes to determining which plan is best for them, and then the administration simplification that Tom spoke to. So consumerism, I think, equals private exchanges, or private exchanges equal consumerism. Now, I'll end on this last point by tying this all back to the ACA. Because in general, the ACA really didn't impact private exchanges from a regulatory perspective. Nor did the ACA really impact, let's say, large group employer plans or self-insured employer plans. Yes, there were group health plan requirements that self-insured plans and large group fully insured plans now have to cover. For example, the no-cost sharing for preventive service, covering adult children up to age 26, no annual lifetime limits, no pre-existing condition exclusions, et cetera, et cetera. So there are a number of those, but they didn't have a significant impact on fully insured large group as well as self-insured. So setting that aside for a moment, what are two provisions under the ACA that have impacted employer-sponsored insurance and then indirectly private exchanges? And that is the employer mandate and the Cadillac tax. And without going into detail on two of those, I'll turn it back over to Tom just to say that's two areas that we'll talk about today: is the employer mandate, Cadillac tax, how that's impacting employer-sponsored insurance, as well as private exchanges.
Thanks, Chris. Fitting the round peg of what might be a promising reform into the usual square hole of regulation and current subsidies is a difficult task, and we'll talk about that in greater length as well as what's evolving in the marketplace. But we're going to focus a little bit more next on the regulatory aspects of particularly private exchanges, but this evolving area of employer-sponsored health insurance. And with that, it's my pleasure to welcome Mark Hall, who is director of the Health Law and Policy Program and professor of law at Wake Forest. When I need to know something about health insurance regulation without the social values, I always
you can't get Chris.
I can't get Chris, and I usually turn to Mark. He's been doing this for a couple of decades, and he's written a lot of books, and I always do product plays because I had to clean up my office because we're moving in a couple of months. So this is not in print anymore, but a good heirloom, reforming private health insurance that Mark did for us back in the mid-1990s, and a lot of excellent work since then on health care reform, access to care by the uninsured, and insurance regulation. And more recently, Mark took a look for HCFO, the Robert Wood Johnson related organization, that looked at, do we need to regulate these new evolving forms differently or closely? And when Mark says, no problem, let's let it evolve and we don't need to kind of overdo that usually my ears perk up at that. So let's hear what Mark thinks about what may or may not be ahead. Is this time going to be different or more of the same of something that gets hyped for a stretch of time and then turns out to have some problems? Or should we just wait and see how it evolves? Mark.
Yeah. Great, thanks. And I mean, Chris set a tough standard because he held himself to 5 minutes, but I'm probably going to go a little bit longer because I want to sort of maybe set out a fairly complete report on what I've done. It was work funded through the HCFO program that Academy Health administers from Robert Johnson. And I also do want to shout out to Bob Helms, who's in the audience, who is the one at AEI who picked me out of obscurity, what was it, 25 years ago or whenever it was, to work on the most obscure of topics that is insurance regulation that is now sort of, we've all been drawn into the weeds of and it is a very weedy terrain. So one point is that, nothing important has happened in the field of health insurance without just a tremendous amount of regulation, and you just start with the alphabet soup of ERISA and HIPAA and COBRA and, managed care backlash. And so it sort of dawned on me that if private exchanges are going to take off, there's going to be this regulatory response. And so I wanted to try to get out ahead of that and think, is there a need for regulation? If so, what sort? Surely something, concerning must be going on here, and what is it? So it's similar to some other work I've done, which I won't refer to, but basically taking a thorough look at the problem, it's very gratifying to say, no problem here, no smoke, no fire, nothing particularly to worry about. And largely because, as Chris said, the major elements are already regulated in terms of the products and the markets. And I think one thing that sort of made time ripe to think about private exchanges for employer sponsorship as well as non-group purchasing is that the ACA not only sort of put into motion a large-scale exchange process. I mean, we'd seen exchanges work well already in Medicare Advantage and Medicare Part D through Medicare Modernization Act, that this really can work. In markets that economists would say, oh no, the information confusion, consumer burden, it hasn't been an issue. So we've seen this as well through the ACA exchanges. So that's sort of one sort of operational proof of concept, but the other is the regulatory market reform. So the idea that you sort of get smooth out a lot of these regulatory gradients between different rating rules in different parts of the market that remove some of the sort of the artificial inducements to set up these group purchasing arrangements that previously existed. But still, there was, at least in my mind, some concern that there might be some regulatory gaming or circumvention going on, and I'm here to report that there's not. So here's what I did. I talked to several dozen people around the country who are really plugged into this, people like Chris, so maybe half a dozen or so lawyers, that was extra duty pay, but maybe a dozen or so exchange operators, a dozen or two major health benefits consulting firms, employer trade associations, sort of saying, are any of the following happening through exchanges that might cause this regulatory concern? First, is this just basically an exit ramp from employer sponsorship where employers just sort of get their workers used to picking their own coverage, and then they drop sponsorship and send them off to the public exchanges. That's not happening, even though some of the early adopters were from more troubled industries or lower wage workforce. They've stuck to what this method of offering. There might be some modest buy down in benefits, in that people, given the choice, trade-off between premium and coverage, choose, let's say, high deductible plans or narrow networks or something of that nature. That's their choice, and it's not being used as a tool to sort of ratchet down employer sponsorship. Another concern was, is this just sort of some sort of gambit to allow inappropriate self-funding? So there's a lot of debate about whether medium and small groups should be self-funding as large groups are, and whether, if that happens, is it regulatory circumvention or inappropriate risk? And we saw troubled uses of the exchange idea back in the 1980s under the phrase MIWA, multiple employee welfare arrangements, that were sort of inappropriate uses of self-funding. But that is not happening either. They're not being marketed as a way to shift to self-funding. Just the opposite. The hope is that self-funded employers will buy, at least some carriers hope that they'll buy underwritten coverage. But in any event, it's not being pushed in any sort of self-funding environment or MIWA type thing where you're trying to pool risk across employers. Each employer remains its own separate risk pool as the regulatory environment asks for. Otherwise, are there signs of any regulatory circumvention, trying to get around requirements of the ACA in terms of essential health benefits or the employer mandate? No, that's not how exchanges are being marketed. And again, there was sort of concern in the past that exchange structures were ways of trying to kind of inappropriately cross regulatory boundaries, but a lot of those boundaries have been smoothed out, and in any event, they're being marketed, developed in a way in which groups remain in their sort of regulatory landscape in an appropriate way. So that and a longer list of sort of potential concerns were all sort of systematically disabused through this series of expert interviews, and my report specifies. Then I got to thinking, well, okay, so there aren't these regulatory concerns, but the notion hasn't taken off as quickly as we first thought, and Chris alluded to this, but I mean, you can see stuff that consultants and whatever were saying. We could expect by now maybe 20 to 30 million people, and within a couple of years, maybe 40 to 50 million people using private exchanges, and the current numbers are a lot lower than that. I mean, maybe 5 million or 6 million, something like that, but so are there regulatory barriers that are inhibiting their development? Or are there ways that sort of the regulatory environment might facilitate them? The big issue is tax, and I'm going to save that for Peter and others to talk about. But I looked a bit more into ERISA, and a lot of what I'm reporting I learned from Chris, so he can correct if I misrepresent it. But we saw, particularly with respect to the use of defined contribution. So one attraction of the exchange idea is you give a voucher basically and let the worker shop, and that's a defined amount, which makes them more cost sensitive, more sensitive to value at the margin. So if you do that, does that relieve the employer of a lot of sort of ERISA responsibility in the same way we saw with defined contribution for pension retirement benefits, whereby give the money to the worker, let them manage their own 401k, and the employer's off the hook for any sort of mismanagement of the funds or picking bad funds or what have you. So reducing sort of the onus of ERISA's fiduciary duty. Would that facilitate the use of exchanges? And the short answer is, and I've spent already too much time referring to ERISA, but no, there isn't really much regulatory onus through ERISA with respect to insurance benefits. The employer is not held responsible for, the quality of care or things like that. So basically, ERISA is not an area of concern in terms of the minds of the people I talk to. The big question is, can an employer basically switch to a pure form of defined contribution, giving a voucher that allows the worker to shop in the individual market, the non-group market, without true employer sponsorship? And that's much more of a tax question than it is an ERISA question. So with that sort of concluding remark, I'll turn things over to our tax expert.
And that does tee things up nicely for Peter Nelson, who is Director of Public Policy at the Center of the American Experiment. Nothing's blown up in the lab thus far, but it's still early. Peter started talking to me a couple of years ago, doing some really hard digging and some exploratory legal work on just how difficult it might be under the it's always evolving regulatory grid. Sometimes they make stuff up as they go along that might make it harder to pull off that type of defined contribution platform in which an employer would make it possible for their employees to find coverage in the individual marketplace with some support around it in terms of financing and whatever else the employer wanted to do. Further background, Peter works on not only healthcare, but energy, state budgets, and state governance. Just testified on, I think, some aspects of this issue. State legislature in Minnesota yesterday, has a law degree from the University of Minnesota Law School, and it's a long and complex path, so Peter's going to have to oversimplify a little bit as to try to explain the world of regulation and tax policy from one perspective, and what might be some more promising ways to not just file another lawsuit, which is the usual strategy, but think of a different way to work around that issue. Peter?
Yeah, good morning. So I do work for a state-based think tank, and what that means is I don't care about changing the federal law, generally speaking. But that doesn't mean I don't have to intimately know the federal law, because it turns out that every time I seem to propose a healthcare policy that I think will be good for the state of Minnesota, there's some sort of federal obstacle in my way. And so I'm constantly running into a federal law. And when I started looking at healthcare issues a long time ago, I first looked at state small business purchasing cooperatives. And I investigated those, tried to figure out whether those might be a good idea to promote better coverage for small employers. And I concluded no. And then went to law school, and I started getting involved in developing arguments for why federal law should not preempt state bad faith claims against insurance companies on the part of employees under employer-sponsored plans. And the Fifth Circuit agreed with me. The Supreme Court did not. But through all of that, I started beginning to understand, I think a lot of what most of us understand is that there's a lot of things that don't make sense about our employer-based healthcare system. So on the purchasing cooperative side, the employer was still the purchaser. They were still in charge of that decision. The employee, the consumer, nothing changed for that employee. And when it comes to state bad faith claims, employers just weren't strong advocates for their employees. And that really led me to the conclusion that one of the fundamental problems in our healthcare system right now is that most people generally don't shop for their health plan. There's not a consumer influence on the insurance market like we see on most of our other marketplaces. And prior to the ACA, the leading healthcare providers really kind of agreed with that position. The AMA and the Mayo Clinic really stood out there with a pretty clear statement that individual ownership of health plans was an important goal. And so that was prior to the ACA. And prior to the ACA, much of my work focused on insurance exchanges. I thought insurance exchanges, under the current federal regulatory framework at the time, I thought those insurance exchanges were the best tool to connect people with health insurance in a way where they started having more choice and control over those decisions. And the reason for that is because insurance exchanges were kind of a neat little tool that allowed us to align some differences between how group coverage is regulated and individual coverage is regulated. At the time, if an employer actually set up one of these defined contribution arrangements where they just pay a fixed contribution to an individual market coverage, it was basically seen that that individual market coverage all of a sudden became group coverage and was regulated under federal law as group coverage. Well, most states' individual markets just did not align with these federal rules. And so that was a problem. These insurance exchange ideas that we heard about before the ACA were really a solution to that. They were trying to create this sort of hybrid group, consumer-driven model. And so that was prior to the ACA. Move forward, the ACA gets passed, and a lot of us looked at the new federal landscape and thought, wow, there's now a new opportunity for defined contribution health plans that really don't need this sort of convoluted insurance exchange idea that we had prior to the ACA. And that's largely because the ACA really aligned the individual market regulation with the group market regulation. And the most important thing it did is it basically told employers, look, if you go out and give your employees a defined contribution, $500 a month, and ask them to go into the individual market and buy their own coverage, they were guaranteed that when their employee went into that marketplace, they weren't going to be denied coverage. Despite all the problems that I see with the ACA, the guaranteed issue community rating regulations guaranteed to employers that their employees would be taken care of in the individual marketplace. So we really thought that was going to open some new avenues to defined contribution health plans, and it really represented possibly a great opportunity to expand the consumer role in choosing health care. However, in September of 2013, the federal government issued federal guidance basically barring employers from funding individual market coverage. This is, of course, a big blow to defined contribution health plans because that's exactly how those were going to be structured. And they didn't give you much explanation for why, but the federal government claimed that when an employer does this, they violate the ACA's annual dollar limit prohibitions and the ACA's preventive services requirements. Behind those arguments, behind those claims, there were two reasons why the federal government wanted to bar this situation. And that's because, one, they were really worried about the possibility after the ACA passed that people might be able to double dip on tax advantages and be able to fund and basically be able to take advantage of a tax credit in an insurance exchange and then pay for the rest of the premium with pre-tax dollars. That was a problem. They were also worried that large employers that had sicker pools of employees might opt for this defined contribution arrangement and dump their sicker pool of people into the individual health plans. So that's where we kind of stood in 2013. And again, I work at a state-based think tank. I'm not going to change federal law. I can't change the federal guidance. But I don't like taking no for an answer. And so I went to work trying to figure out whether there might be ways to revive opportunities for defined contribution at a state level. And to do that, I've basically developed what I think is kind of a simple idea. So the problem with the federal guidance is it tells us you can't integrate individual coverage with a group health plan. And so under that traditional framework that we used to have, the employer would just reimburse an individual after they purchase coverage in the individual health plan. So the individual was purchasing the coverage. Under my proposal, instead of the individual purchasing the coverage in the marketplace, the employer purchases the coverage on behalf of the employee. And the state then defines this as group coverage. So it, in many ways, merges elements of the group marketplace with individual markets, and in many ways, kind of the same way that before the ACA, we were talking about using insurance exchanges to merge elements of individual and group coverage. And in doing so, and by basically calling this group coverage, this idea solves the federal government's problem. by calling it group coverage, it cannot qualify for tax credits. So problem number one solved. And in my case, we've targeted this to small employers, so it can only be used with small employers. And that being the case, it restricts large employers from dumping their sicker pools into the individual marketplace. So that's a proposal I have at the state level, and we had a House hearing on it yesterday, and I'm pleased to say that it passed the House. And so we've got a lot more work to do because, as you might imagine, there's a lot of questions around how in the world a state could somehow kind of sidestep federal guidance to revive these defined contribution arrangements.
And I just want to interject to say this. So one, I've spoken to Peter a number of times about his idea, and I think it's a great idea. And it's funny you said about you focus on the state. Like I'm here in Washington D.C. I'm a federal guy, so I have focused on the federal guidance, kind of all the rules pre ACA, the legal fiction that they've created with the federal guidance that Peter spoke to. And I wrote an article on this that I could provide to Tom to distribute that really gets into the details of kind of the legal fiction that was created and the whys to really bolster the points that Peter made, which I think was a very good explanation of that federal guidance. And I'll also note this, because I know we're going to talk more about this issue, is Congressman Bustani and Thompson, Senator Grassley, and Heitkamp actually have legislation that would reverse the federal department's guidance that Peter spoke about and that I wrote about in this article, would kind of turn off that guidance for at least small employers below 50 full-time equivalent employees. That legislation is moving through the process, but it is out there on the federal level in addition to what Peter is doing on the state level.
That's right, and there's always that hope for magical, elusive waiver, which may be contrary to existing law, but people can imagine that might happen someday in the future. Peter didn't say whether you're going to call that the intergroup market or the grindividual market. You always got to do that proper merger to get the fix. Now,
Call it the merged market in our legislation.
Merge and purge. That's fine. Now, we've been talking about ways to evolve through a different type of platform away from the employer group market. And, there are employers who are saying, we are still here. We are engaged in more thoughtful next stage group coverage, and we've got some other tools that we need to build upon and do it differently. And with that, we dial in Tevi Troy, who is CEO of the American Health Policy Institute, more recently heading up a major initiative called the Health Transformation Alliance of a number of major corporations with a lot of diversity behind that. Tevi's also, as you know, the author of the best-selling book, What Jefferson Read, Ike Watched, and Obama Tweeted. Apparently there's a revised edition coming out, and Trump Retweeted, I think would be the follow-up edition. Now, the highlight of Tevi's career, of course, was when he was a researcher at AEI, but he, fell into lesser work since then, including being Deputy Secretary of the Department of Health and Human Services, 2007-2008. A lot of experience at the White House, including Deputy Assistant and Acting Assistant to the President for Domestic Policy. But we want Tevi to speak today primarily about we're not dead yet. Employers, in fact, have some creative thoughts, ways to not just give you the same old, and give us a little preview as to what they're hoping and planning to do, which will roll out in several stages. Tevi?
Yeah, employers are not only not dead, they're not even mostly dead. So, I'm glad you mentioned my time here at AEI, racing to get here for a 9 o'clock start. It reminded me of my first job when I was working at AEI, commuting here for a thing. And Bob Helms was there back in those days, so it was good to reconnect with him here today. I do want to talk about the big picture for employers. The employers, it's interesting, when I was in the federal government, we used to talk about the federal government as the payer. And then when I went out to the private sector, the insurers always called themselves the payers. But the employers always jump up and down, and they hate this. They say, we are the payers. We're the ones who are paying. And in this experience, in this frustration of theirs, they find that not only they're paying, but they're paying more and more, and they're not always liking what they're getting. And my friend Chris mentioned something about the ACA didn't really impact large group health. Well, the employers don't see it that way. In fact, we did a study that found that as a result of the ACA, the marginal cost of the ACA to large employers is about $5,000 per employee over a 10-year period. Now, part of that is the Cadillac tax, which you mentioned, but it's not all that. There's a whole bunch of other requirements through the ACA. And that kind of number is the kind of number that shows up in the boardrooms, it shows up in front of the CFO and the CEO, and it leads them to start to want to make different choices about how they go about healthcare. They also are seeing kind of the direction of federal policy. I would say that the large goal of the ACA is to move people, and not just the ACA, but federal policy in general, is to move people from private-sponsored healthcare to some form of government-sponsored care. The original CBO estimate on the ACA was that it was going to bring 32 million people, newly covered people, 16 million through the exchanges, 16 million through Medicaid. We've seen that that's not true. The numbers are actually higher for Medicaid. About 71% of the people covered are being covered via Medicaid, but a lot of people covered through these government forms of healthcare. A lot more people going into Medicare. People are retiring at the rate of 10,000 a day. And we did a study that just compared the cost of each individual in some form of government-sponsored care. And so we looked at Medicare, Medicaid, VA, and also some people who are in private sector care. Now, I recognize there are different populations and that the people covered by the federal government up to this point largely are poor, older, sicker. So they're going to be more expensive. But there is a big difference, a big gap. We found about $9,000 per employee covered by government-sponsored care, per person covered by government-sponsored care, and about $4,000 per person covered in private sector care. A little lower in smaller companies and about almost up to $5,000 in larger companies. Now, again, recognizing it's different populations, but to the extent that federal government policy is pushing people away from employer-sponsored care and other forms of private care into public sector care, we have to recognize that the costs for each person we cover are probably going to be going up. At the same time, we're reaching a point what I call hitting the wall. In that period between 2025 and 2030, you're going to have a point where Medicaid costs go over $1 trillion. You're going to have the Medicare trust fund go bankrupt. You obviously have Social Security is facing all kinds of challenges. And from the ACA's perspective, the Cadillac tax, if it goes into effect, I know it's been delayed, but if it goes into effect, it's going to hit the average value health plan. So employers are looking at this and saying, around 10 years from now, there's going to be a big problem in healthcare in terms of a lot more people going into government-sponsored care that the government won't be able to afford it. And also there are these dire predictions of employer-sponsored care going away. Zeke Emanuel, who was instrumental in the Obama healthcare plan and part of the ACA, worked in the White House, has predicted that by 2025, less than 25% of employers are going to be providing healthcare to the employees. Now, I am here to say that I think that prediction is premature, but it is not premature to say that employers are looking for something different. I'm not sure the answer is private exchanges. I was surprised at Mark's prediction that 40 to 50 million people are going to be in private exchanges in the relative near future. Is that where you're, I guess, by what year?
That turns out to be false. That was predicted by others, but
I don't see that happening. And to the
Difference between surveys and predictions and actual experience.
So large employers that I'm talking to, the private exchanges don't seem to be catching on with them. But the employers are talking about something different. And what they say is they want to move from some kind of employer-sponsored care, which is where we are now, to some kind of employer-facilitated care. And what is employer-facilitated care? We're not what does it mean? We're not exactly sure. But one thing that we're looking at is to try something different in the terms of this Health Transformation Alliance, which is what Tom mentioned earlier. The employers are looking for price stability, they're looking for choice, they're looking for consumer-directed, which you guys have mentioned. They're looking for employing technology better and smarter. And one thing I hear from these large employers is that there's all these great new technologies, all these great new applications out there, and the employers are not taking advantage of it. A, because the people at the companies are just too busy to hear all the pitches that are out there. B, if they could hear all the pitches that were out there, they don't have the capacity to assess which technologies are really life-changing and altering, and which ones are just another new cool screen on your iPhone. And then, even if they could assess which were the best technologies, they don't have the nimble enough systems to be able to adopt these new technologies. So there's all kinds of things that employers are looking for, and they're not sure how to get them. And so one thing that we have just tried, and we've announced in the last month or so, is this Health Transformation Alliance. 24 large employers, including Coke, Verizon, American Express, Macy's, are joining together. They want to work together on their on purchasing of healthcare, but also on looking at data. They have 4 million covered lives among them. They spend collectively $14 billion. And so the idea is to look at the data from all these 4 million lives and their health interactions and what's going on in the marketplace, what's working, what's not working. Come up with strategies, and at these big companies, you have a lot of really smart people who've been working in healthcare for a long time, and they can identify patterns and see what can work and what can't work and what should be improved. And then use this collective leverage of $14 billion in total spend to have the muscle in the marketplace to carry out those strategies. And so we've heard about employer coalitions before, but this is the first one, I think, that A, is of this magnitude, but B, also has this collective vision of taking data, using it to create strategies, and then having the leverage to carry out those strategies. And so we're in the early stages. Can't tell you exactly how it's going to play out, but I think we've got a good start, and I'm looking forward to having another panel discussion about this in a couple of years with an update.
Which is always a nice thought. Thank you very much, Tevi. We're going to shift now to recycling back on, now that you've had your appetizers, a little broader roundtable discussion, and we'll maintain the boundaries to some loose extent, but it's much more of a free-for-all, with the exception that no one is allowed to say he started it first as part of the discussion. Otherwise, it's pretty much the usual playground atmosphere.
It's a fairground.
That's right. That's right. We'll start back in the private, and these do kind of evolve, because you can see the private exchanges merge over onto defined contribution. We've got different types of employers in different circumstances that face kind of different challenges. Regulatory grid, ways to throw in more on the large employer side is to open up the box a little broader, depending upon what the traffic will bear. But let's start back in the private exchange space with Chris. Chris, you've heard that, and you've acknowledged that this isn't exactly, we have all these, new products and new approaches in healthcare. This is going to be the greatest new thing, and it has all kinds of predictions as to how it's going to sweep the field. And then it turns out it's a little bit more of an evolutionary grinding process, and sometimes they take off, but they take a little longer. What is both the potential and the practical limits, speed limits on moving to private exchanges? Does it depend upon what slice of the market you're in? Is it just the adaptation and evolution to something else in the midst of other alternatives, or do we have public policy problems, or what in effect is both the high end and the low end potential of private exchanges?
It is an excellent question. I think to the 2 points you made, I think it comes down to what market you might be in, or what size of an employer you are. Are you fully insured? Are you self-insured? So I think it comes down to that. And I also think it does come down to the evolution of private exchanges and how these vendors are putting their business model together, the type of technology that they're leveraging and they're offering to employers, and the cost associated with that. From a public policy perspective, I don't think it has much of an impact, but I'll table that statement to add to some comments that Mark made with regard to regulation that we don't quite see now, and I've said that Mark has elaborated on that, but could there be some regulation coming down the pike? And I think the answer to that is yes. So to your question about the slicing and dicing, one thing, 'cause I'm an employee benefits attorney by training. So I worked a lot in the health benefits space when it comes to employer-sponsored insurance, the tax side, the HIPAA side, the COBRA side, all that fun stuff, right? When I got to the finance committee, I wasn't so much of a pure state insurance law guy, but on the committee, as most may know, having worked on the Hill or knowing staffers, you learn as you go. And so I became much more of an insurance guy, if I could call myself that, during that process. And the way that I started to understand the insurance rules is by compartmentalizing the markets. So I say that to say, it's compartmentalize the markets when it comes to where's going to be the growth of private exchanges. You have the small group market, right? So you got the small guys. They are primarily fully insured. Fully insured, you're kind of stuck as an employer to what the carrier is charging you from a premium perspective. Now, the ACA, as we all know, made significant reforms in the small group market. But the White House and the administration has introduced a transitional policy which allowed small employers to hold on to their non-ACA compliant plan for a period of years. And literally, the majority of small employers out there are still on non-ACA compliant plans. So they've really not felt the brunt of the ACA small group market reforms. Well, the transitional policy is going to end, now it's been extended to December 31, 2017, depending on if your state adopted the transitional policy all the way through to that time frame. Some have, some haven't. But the point of the matter is, a lot of small employers are still on non-ACA compliant plans when they have to switch. Should the ACA stay intact past 2017, et cetera, then I could see more small employers, for example, looking to private exchanges as an option, A. B, small employers are already looking to private exchanges as an option because they don't want to, the employer that is, wants to make their widgets as opposed to looking through the spreadsheet with their agent and broker each year as to what deductible I want to charge this year, what copay do I want to charge this year. A private exchange allows the employer to kind of allow the employees to plug their employees into this platform, shop for plans, decision support, education tools, defined contribution. The employer can step back a little bit, but still is the facilitator, as Tevi mentioned. So that's small group. So let's take kind of the mid-sized guys. So they're large group, fully insured. To clarify my point about the ACA not impacting fully insured large group, they did, but my comment was more on the group health plan requirements. And I've heard actuaries indicate that it was about maybe a 5% increase to cost as a result of that. And I compare that to like small group where those changes are like 35 to 50% cost differential. So that's the only reason why I mentioned that. But I thank you for the clarification. And that study, that number is actually intriguing. I've not heard that. And that makes sense to me because if you add up all of the provisions that might have a small impact on employer plans and you add them all together, it comes out to a larger number. So sorry for the digression. Back to mid-sized, large group. They're in the fully insured market. They don't have enough lives to self-insure. They might not have the capital to self-insure. They're looking for an option. They, too, don't want to look at the spreadsheet each year to say what deductibles, what copays, what type of plan do I want to offer. And a private exchange allows the employer to continue to facilitate that coverage, but allow the employees to choose, to have the defined contribution, to have the technology that's available, i.e. decision support education tools. So you're going to see, and we're seeing more of the uptake in the mid-sized. So now let's shift to the large, and then I'll stop talking. The large folks are primarily self-insured because they can. They have the lives, so they have the risk pool, they typically have the capital, and they're looking at private exchanges, and Tevi could speak to this maybe more eloquently than I, or more detailed than I, looking at it with a skeptical eye. They're saying, how's a private exchange much different from what I'm doing now? I'm self-insured. I offer 3, maybe 5 plan options. Maybe I'm not offering 8, but I'm offering at least a couple so my employees do have choice. And if I actually go to 8 and 10, isn't that going to affect the employee's decision-making process? Because as we've seen, psychologists have said, more choice sometimes causes brain freeze. My response to that is, well, that's why you have a decision support system that is intended to help the employee find the right plan that is best for them. So at least that's technology that was not available previously that is now available to these self-insured employers, but they're still not convinced. And I think the reason why they're not convinced goes to the evolution side of this. In my opinion, and this is my opinion, private exchange vendors are charging a lot of money for these services. And I think that the dollar perspective when it comes to, let's say, contracting or working or partnering with a private exchange or a private exchange vendor, when you crunch the numbers at the end of the day, doesn't produce significant enough savings and may not produce savings at all. And employers then go back, the larger ones say, well, again, if it's not any different from what I'm doing primarily, yeah, I get the technology. If it's not saving me any money, why should I pull the trigger on it? So I don't see a swift movement to private exchanges with the large self-insured folks. Maybe in the future, and I really like the employer-facilitated idea, and we can expand upon that. But that's how I see the evolution. Small group, yes. Mid-sized, yes. Large self-insured employers, much slower.
Okay, well, we're at the large size of the market. Tevi wanted to comment. I'll go to Mark in a moment on some other aspects. Go ahead, Tevi.
Yeah, I completely agree with Chris's analysis about the large employers. From the ones I talk to, the attitude is that not only is there potential cost, although the private exchanges do promise large employers either cost flat or cost savings in the first year, but it sounds by just saying we're going to promise you the first year, it sounds like maybe there's a bait and switch going on. Who knows what's going to happen in the out years? The second thing is the employers feel a loss of control. They do want to have a say in their employees' health. They want to say in how their plans are played out, and they feel like with the private exchange, they're having pretty much what they had before with minimal savings and with loss of control. And I think that's one of the reasons why they're not so eager to go into it. So that's good clarification.
Before we get on to the regulatory aspects a little bit further, we kind of slid over a little bit, and although they're easy to not notice, it seemed like there was supposed to be this innovation of the shop exchanges, which are going to, take over the marketplace and have all the small employers empty out. It's hard to find anybody in them. Even in the individual market exchanges, if you're not heavily subsidized, it's hard to find anybody in them. So the magic of an exchange, at least done through public channels, seems to have some real limitations. Maybe private exchanges do it differently. What's going on in terms of what was hoped for, in terms of other versions of exchanges that don't seem to have ignited on the public side, and whether is there a competition between the private version of this and the public side, or they just have different roles in different places?
I'll start. I know we have similar knowledge base on that, but a couple things. So the shop component of the public exchange has not taken off at all, and there are a couple of sort of standard explanations that I think are true. One is that the tax credit that was available through that did not turn out to be sufficiently attractive to draw much purchasing. There's Chris's point that a lot of small employers just want to keep what they have for now. The third is that there are a lot of sort of technical issues that got put on the back burner in order to get the non-group side of the exchanges up and running, and then to make further improvements, so that various aspects that were supposed to be distinctive about the public shop that would allow selection among competing carriers by the worker rather than the employer. If it's the employer picking the carrier, then it's not really that much different from how employers currently shop. And so even if they were to look at ACA compliant coverage, they have a broker, they have the regular market. And generally speaking, brokers say, look, I can spreadsheet everything for you. You don't have to go, do it this new way. What's distinctive is letting the worker pick, but that involves complexities around concepts known as list billing and composite rating that I'll only go into if somebody asks me a question. But those were technical problems that had to be worked out, and I'm not sure that they have been fully worked out, but that would allow that aspect of there are all these concepts of vertical choice and horizontal choice, but giving sort of full choice to the worker was sort of slow to come around, and I don't think has been fully implemented. So I think those are some of the things that sort of kept it from being sort of this distinctly new way of offering coverage.
Peter, I'd love to hear your thoughts, but let me just add to say, because I've analyzed the question this way. When you look at the individual market, those, let's say, private companies that you could call a private exchange in the individual market, they don't compete with the individual market ACA exchange. And the reason is, to Tom's point, there's the subsidy, and the subsidy is only available through the actual ACA exchange. Yes, there's something called a web broker entity where a private company can be a proxy for the ACA exchange. I don't want to muddy the waters by getting into that, but the point of the matter is you have a private exchange in the individual market, does not compete with the ACA exchange because the subsidy is here and not here. When you shift over to shop, and it's funny, back to the comment about my time on finance, and I take my lumps as a Republican being involved in drafting many of these provisions, and I was involved in drafting many of these provisions. Not to say that I liked many of the ideas that we were drafting, but we were there to work through from
Stockholm syndrome, isn't
technical perspective. You could call it.
Did you draft that one that went to the Supreme Court last year?
Well, here's the thing: the electroshock therapy is doing a little bit of work. The memory is fading a bit, but it's not as easy as I would like it to. And to answer your question, yes, sadly, the point of the matter is, when you draft those provisions, granted, sometimes we don't like their idea, but you work through the technicalities of it. And one of the issues, why I say all that to say this, was the small business tax credit. And the small business tax credit was fairly robust early on in the drafting process to actually be an incentive for folks to go to the shop exchange, because again, that's where the tax credit lies, similar to where the subsidies lie in the individual market. Over time, that small business tax credit cost too much money. So we as staff had to water it down. cut it back further and further and further, and we got to a point where it was infinitesimal and very limited. And then when the debate went partisan, and I was on the other side of the debate as a Republican, I wrote speech after speech for Senator Grassley, who was my boss at the time on finance, to say that the small business tax credit is 100% ineffective. And I was trying to push back on Democratic members who said, well, I support the ACA because it's good for small business. And my point was it's not, because you don't have the tax credit. So back to the competition. You have private exchanges, you have shop exchanges. You have no incentive for someone to go to the shop exchange. You have every incentive to really go to the private exchange because the administrative simplicity is much greater, or less complex. The technology is there where you do not have it in shop, and it's much easier to work with a private exchange than a shop. So in that case, private exchange do compete with shop, and I think shop is withering on the vine, and I've suggested that for a while.
Can I just, one quick
Okay.
question? My impression is that the private exchanges aren't really going for the small groups, 50 and under, that they're pretty much selling just to the 50 and above. Now, if small group market regs had expanded to up to 100, we might see more direct competition in that mid-market range, but that's my impression is that the private exchanges are leaving the under 50s to something else.
And there are some entrepreneurial, you obviously pick markets, right? And you see where there's a vacuum. And there are some folks that are in the below 50. But to your point, just like any agent or broker, you want to be in the larger group space because that's more revenue for you because you have more lives. But there are some. But your point is still well taken.
Well, not only is there a race to the 100 ceiling, but Congress seemed to think that wasn't a good idea either last year in terms of slowing down the onset of those regs. Dial in, Peter, at this point, and you may want to speak on something else. I know at one point in the past, Peter, you thought that there might have been another hidden motive in terms of the resistance to the defined contribution approach, which was, well, we need to prop up those shop exchanges because if these private competitors get in there, we're not going to get the market we want. But go ahead.
Yeah, that's exactly right. You have to wonder about these regulations because the regulations don't explain themselves. They don't offer a good rationale, and really the only rationale we've heard from is that the U.S. Chamber sat down with the Obama administration and talked about the issue, and it's in a letter that they wrote. That's really the only direct evidence we have of why this guidance came forward to ban employers from funding individual coverage. So you kind of have to guess. And yeah, I mean, with the shop exchange, without the incentive, the proper tax incentive to use the shop exchange, who really was going to use it unless it really became the only avenue to use the exchange process to deliver a defined contribution arrangement. If it really gave that defined contribution benefit, then yeah, people would use it. But as we're seeing now, and people aren't using it. I believe in the first year in Minnesota, just a little over 800 people were in the shop exchange. And that's almost zero people in my mind. And so yeah, it really isn't competing with these other exchanges. And even in the private even in the individual exchange market, though, it's really just there serving, at least in Minnesota, it's just serving people who are qualifying for tax credits.
All right, just to get back on the regulatory front, Mark, just to kind of get to the mega view, are you buy, sell, or hold on these innovations? Because one of your regulatory stances seems to be, which I like, if you don't just do something, stand there and see what happens. Mm-hmm. But there's a bit of a regulatory dialectic we've seen in the past, which is private market innovates, folks react and regulate, then they do an arbitrage to get around the regulations, and then maybe somewhere out a couple of decades later we innovate in a different manner. So with that longer history behind it, it's been a slower pace. Do you see that changing in the next 5 years?
Only if we move the direction that Peter and Chris have referred to with legislation that would allow tax credits. Preferred tax treatment of premiums in the individual market. I think that would raise some concerns, which I just want to mention quickly. One is that the small group individual market is age rated and community rated with age adjustment. So if you give people vouchers, they have to be age adjusted, which means some vouchers are worth 3 times more than others, which differs from the standard composite rating approach where every employee is treated the same. So that raises concerns, I think, in terms of perceived or equity and what have you. The other is I forgot what the other is. I think it has to do with risk adjustment, but it slipped my mind.
Sorry, as long as that doesn't involve eliminating a cabinet department, you're in safe.
The Department of Education. That was so. The thanks for associating. Oh,
We'll
here's
stay
my
there for
glasses.
okay.
Yeah,
We'll stay there
anyway,
for a second. Okay.
Exactly. So that sorry, he gets me going. He's a funny guy. All right. So that aside, I think in the larger space, that's what I wanted to refer to. What I would like to see the private exchanges evolve to is true managed competition in the form that Alan Enthoven first painted for us. While Alan's still with us here to enjoy seeing his idea take full fruition, and that requires really competing carriers. So there are exchange constructs that allow what's called right sizing of benefits. You give the employee an incentive to pick the level of deductible and sort of cost sharing arrangement that makes sense for them. But what we haven't seen yet, but I think there's a real potential, is to sort of right size the network. And we see that emerging in the ACA public exchanges. But to get that, I think we really are thinking about more sort of differentiated competition among different networks that are, sponsored by different carriers. That has the potential in the large group sector, but you have the inhibition of the added administrative cost, as well as losing the self-funded advantage. It would be great to see something to sort of equalize some of that. But the problem is, I think, in the small and the mid-sized markets, carriers are very reluctant in those markets to compete on a risk-bearing basis head-to-head at a retail level for individual choice without some functional means of risk adjustment, and so we need to
describe
solve that problem.
there's two types of risk adjustment.
Yeah.
If you're big enough, it's a lot easier to do the risk adjustment than the more individualized within group as opposed to between groups.
Yeah, exactly. So risk adjustment can be done within a large group. So if you have 3,000 employees, you can get carriers to agree to say, if I ended up with the bad slice of that, and the other carriers are willing to make up that difference, I'll do that. And the actuaries say 3,000 is enough to get actuarial credibility to do that. But if you're dealing with a group of 200, there just aren't enough lives there to risk adjust within the group. You can't feasibly require risk adjustment across groups because these groups are experience rated. So then you'd be requiring the group itself to pay more. We can do that in the small group market because it's community rated. So that's a lot of technical stuff in one.
Isn't it also, we find the way, if you regulate things a certain way, you're probably going to have to subsidize them a certain way. Or if you subsidize them one way, you're going to have to regulate them that way. The
Yes.
two intersect with each other and have to somewhat be in alignment, or you'll get more mismatches.
I think that's the bigger observation. So it's sort of the devil we didn't choose that comes along with it.
I want to get back to some of Peter's work, because Peter, you're coming from the standpoint of, that's fine, you got your businesses and you're doing your business, but there are people out there, as there may be individual employees, there may be other individuals stranded apart from what's already been set up on the table, who need a little bit more of a voice and choice. Now, you went through a very complex layer of, multiple years and ambiguities in tax law, regulatory treatment. Clearly, folks are fighting back up against you to do that. What's the case for a pure version of this? What's the upside? And how do you manage the pitfalls in light of the deck's been somewhat stacked?
Well, I think the case for a pure version of this, which I would define as an employer giving that $500 a month or a portion of a premium, a percentage of a premium.
Or competition within
employee.
a regulatory framework.
Yes.
But what's the regulatory framework?
Yes. So the regulatory framework right now, you've kind of discussed, I think, one of the big obstacles to exchanges taking off in the large group marketplace, and that's the fact that we're trying to shoehorn this individual choice model into the group coverage insurance market. And it's still a group coverage insurance market. And in the past, I believe that's really the obstacle that private exchanges ran up against. There was ongoing problems with insurance companies working alongside other insurance companies in this insurance exchange in a fair way. And risk selection became an issue. And so we never really saw this take off before the ACA. And I have substantial questions whether we'll see it take off after the ACA, because that's going to continue to be an ongoing problem. And at the end of the day, it doesn't deliver one of the important things I think a lot of us think we should have, and that's portability. it's still a group coverage plan, and you still lose it when you lose your job. You can't take it with you, and that just pulls that deters the competition that the true individual choice model might bring to the insurance marketplace. And it's that individual choice model that is not tied to your employer that I think is so attractive. Yet I do want to put a plug in, though, for the employer role. I mean, I want to, again, put a plug in for the employer facilitator role, because employers do something that you really can't do outside of that, outside of the employer context. Employers do get people covered. They do very successfully get people covered. When an employer finances your health care, you say, yes, I want health care. Outside of that context, it's very hard to sell someone health insurance that they don't think they need. And so
That's what public policy was for.
Exactly. Yeah, just mandate it. It'll happen. So employers do play that very important role. And after the ACA passed, I kind of felt like we were in an ideal situation. We didn't change the tax code, so the employer role was still very important under that context. Yet we did, in my mind, open up avenues to individual choice.
I'm going to try to do some mind reading and shifting the subject into Tevi's area. We say, you folks are talking once again about, how to move the subsidies around a little bit, all this individual stuff. Meanwhile, you haven't said much about what actually we're getting in healthcare. What are the outcomes that come out of this? How do we change the supply chain, the delivery structure? That's a big role for employers, because it doesn't seem like it's being done by many other people. Tevi, can you talk about what the Alliance is hoping to do on that front? What are both the possibilities and the early going limitations as to when you can get ignition?
Yeah, first I just want to acknowledge and celebrate Peter's comment, which was really smart. I even wrote it down. Maybe I'll tweet it later. Employers do get people covered. They very successfully get people covered, and they cover 170 million people. And so the bulk of people who are covered in this country are covered through employers, and we really shouldn't lose sight of that. And we also should make sure that public policy doesn't either prevent or discourage employers from doing that in the future, because we have not found a better alternative out there yet. Maybe we will someday, but it has not yet emerged. Now, in terms of what we could do better and what we'd like to see, there's a number of challenges. The first is the fact that people just aren't getting great care out there because people aren't taking care of themselves. I hear this all the time from employers who say that I don't have engaged healthcare consumers. Now, I think Chris was making a really good point when he was talking about the 3 options versus the 8 options. To the extent you give them fewer options, they're more likely to pick the option that's right for them, although even with a limited number of options, they're not always making the economically rational decision. I have chief human resource officers and benefits managers who kind of shake their heads and say, if they only made this choice, it would be better for them. They'd get a voucher, they'd get all this stuff from the employer, they'd get a free gym membership, but they don't choose the choice that we think is better for them, and we can't make them. So that's one thing. But in terms of just basic care, we looked at a study that CDC did that said that 58% of people who have high cholesterol are not doing anything about it. And so that is obviously a precondition for heart attacks, strokes, all kinds of problems down the road. And
What
so
you don't know can't hurt you.
it obviously can hurt you very significantly. And so to the extent that we could get people to take care of those kinds of problems and find ways to incentivize them to take care of problems early and not wait. There's also all kinds of problems in terms of pricing. We were looking at some studies that showed that in terms of generic pharmaceuticals, you can get as much as a $200 variation per product per month, depending on where you purchase the product. That seems just insane to us. And the employers who are footing the bill for it say, well, why are you going to this place that costs so much more per month? So there's a whole bunch of challenges in healthcare that are due to lack of engagement, and we're going to have an initiative on lack of engagement, on lack of transparency in pricing, and we are going to do, our first initiative is going to be on pharmaceutical pricing, and then lack of checking out the data and finding out where the data is going. And so the number one overarching thing we're going to do is look at this data and be smarter about how we interpret it.
You have a couple of difficult dances. On one side of the coin, you're making this kind of an inclusive, do what you want to do. We're not, uniform across the board. But you want to have leverage, which tends to mean everybody get in the same boat and kind of do similarly. So in terms of more, if it's not disintermediation, more purchasing leverage to deal with buying the care directly. How do you parse those differences, or is that evolving in terms of what your members want?
That is a great point, and it's a real important tension that you point out. And we've looked at previous employer coalitions, and we found that one thing that led them to run aground is they were overly directed from the top. They said, this is what we're doing, and you're all going to do it. And these large employers who are powerful and successful, they said, well, no, I'm not doing that. And the whole thing falls apart. So we do have some elements of choice in our approach. We're saying a precondition, a sine qua non, is you must include your data. You must share your data so that we can come up with better strategies. But if you decide you don't like the look of our pharmaceutical initiative or our consumer engagement initiative, you don't necessarily have to participate in that specific aspect. Now, we think it will be advantageous to you to do so. But by not being overly directive, I think we're going to have that flexibility that will encourage them to stay. And the people who are in this larger group are not, we're not calling them members or participants, they are owners. They all share in this larger thing, and to the extent that there are savings at the end, the savings revert back to the owners. So having that kind of participation, I think, is helpful.
We'll go to the other topics in a second. On the data front, another tough nut to crack. You've got a lot of lives, but you don't have all the lives. And other folks have tried to do this as well, and we know the other groups that have different assemblages of data. Do you get enough data if you put all this together to be very predictive for what you want to accomplish, or do you have to build bridges to perhaps some other data sources?
I think 4 million lives is a very good place to start. And I think we'll get a lot of information out there. Obviously, if you had some kind of perfect data source that had all 340-odd million American lives, that would be better. But I think in terms of, I'm not saying the lives that are in these large employers are all uniform, but to the extent that it gives a sense of the people who work for large employers and what we need from them, I don't think we need to necessarily compare it to the Medicaid population, which is a different population. I think for what we're trying to accomplish, I think we've got the right number of lives to get the data we need.
Okay. Free for all for the panel. Does anybody have a clue as to what's going to happen in the next 5 or 10 years in terms of, we've seen the limitations and the footholds and successes of the Affordable Care Act. It's in business. It's not going away tomorrow. It serves a part of the market with a lot of subsidies and certain regulatory controls. And the employers haven't gone away. And despite all the forecasts of dropping and other changes, something's going to change, but it seems to be changing gradually. Are we kind of just, rolling with the punches for a few more years, or is there really a light at the end of the tunnel?
Well, I don't know, but yeah, I'd like to hear what you think, because you have such great insights, and I sometimes can tell when they're serious or not. But one thing that's I think worth thinking about some more is the Cadillac tax, because this is sort of a, at some point soon, we'll have this sort of come to Jesus moment about the extent to which, health insurance should be tax preferred, right? And so every economist believes, it shouldn't be. Everybody else believes it should be. And then you add to that this oddity of it's treated one way in the group market, but not in the individual market. And when you strip away the reasons for that, as Peter's done, they don't really hold up. And let me just sort of emphasize again, if you can stop the double dipping piece, which everybody agrees to, otherwise, the previous reason to not prefer the non-group market was it was risk rated. It was medically underwritten. You couldn't get good coverage. Now that's all gone. So there's no principled reason not to favor it as we do the group market. So, but it begs the question: to what extent should any health insurance be tax preferred? So, as an academic and intellectual, I'd like to see some better resolution of that question. It does seem like it's a political question that's teed up that could be addressed in a bipartisan fashion by future Congress, but that's dreaming.
Well, I'll get to Chris in just a second as a tax man, but Timmy, you would say au contraire. You take away my tax subsidies and employer insurance, and the game's off. So there's always the mythical idea of some level playing field out there. We'll have to figure out who's more level and who's less level, and certainly the latest trends on the Cadillac tax side is mañana or later in terms of its onset, when it actually gets close there. Could one way to ask the question, can large employers have a good enough product to compete without having a differential in tax policy? Not taking it away, but perhaps letting more people into the party. Or does that make large employers uneasy? Because that seems to be a little bit of the tension here, which is how do we prop up some type of, mega, but perhaps carefully regulated individual market versus let's hold on to what we've got in terms of employer coverage and it can be made better under different circumstances.
Yeah, there's a lot to unpack in there. First, in terms of Mark's comment about should we get rid of all tax subsidies, it seems to me if you get rid of all tax subsidies, you just would have fewer people covered, right? People would choose not to get covered.
I was attributing that to economists, which I am not, so it's not my position.
You've proven that on many occasions.
Right, but I'm just saying, if we entered this mythical economist realm where there are no tax subsidies, I think you would have fewer people covered. And as Peter said, let's say it again, employers get people covered. I've talked to a lot of people at these large companies who say if the tax subsidies go away, we're not going to participate. That's probably true. I'm not going to say it's 100% true because there are a number of reasons why employers participate. They have recruitment and retention issues. They like to have a say in the health of their employees. So if that guy on the production line has a stroke and stops production for a week, that's a real problem for them. So they want to see, to the extent that they can shape their employees' health, they want to do it. It's part of their corporate ethos. They think it's who they are. They want to say, hey, we're the kinds of nice people who provide health insurance. Now, can they provide a product that competes with no tax subsidy on their own? I don't think they can.
Or the same tax subsidies is the other part of it. Not no, but
Yeah, okay.
you don't have
that's a different
secondary
issue. I mean,
advantage.
I don't think employers would mind the equalization of tax treatment so that individuals could also get a tax break. That might lead some employers to get out, but I think for the other reasons I said, the employers would stay in. But here's the potential. And again, I don't know how this is going to work out, but if the Health Transformation Alliance takes off and works, that could be a product that competes in a world, even if the employer subsidy were not so manifest and were not so much greater than the other products out there.
And permanent employment for you. Good move.
I'm just hoping to retire eventually and get down and play tennis with Bob Helms in Florida. So
We should all be so lucky.
I should say, let me just kind of touch on everything that was said here to say this, and maybe I'm oversimplifying. People need, regular people, all of us, folks out there across the country, need help affording health insurance. So to Tevi's comment, but also to Peter's comment, there's really two ways I look at helping people better afford coverage. The government either subsidizes you or the employer essentially pays for your health insurance through compensation. Now, that compensation is also government subsidized, but let's set that issue aside for a moment. So you have the government subsidizing and you have employers subsidizing. And if you essentially take the employer subsidy kind of away and don't give them an incentive to finance, you're going to lose the coverage numbers, as Tevi mentioned. If you take away the government subsidy because the government said this is just too expensive, then again, you exacerbate the coverage problem. So I think you always need either the government in the game or the employers in the game or both. So right now we have a system where essentially both are in the game, especially now post-ACA. So in a perfect world that I would think about is you merge the markets, as Peter has suggested, or you merge the market in different forms, but the concept is similar to what Peter has suggested. But you do that for a certain size of employers. And then if you have large employers who want to offer coverage to their employees for the reasons that Tevi mentioned, as a benefits attorney, when I was, again, dealing with folks during the draft in the ACA, I said, look, employers want to offer coverage because they do it for attraction and retention purposes, for absentee versus presenteeism kind of issues. So employers want to offer coverage. Some employers don't. So give the employers the choice. Give them an all or nothing proposition of if you want to stay in group coverage and sponsor, you, let's say, get the current tax subsidy, let's say, albeit capped at an amount similar to the Cadillac tax. And then if you just want to not sponsor coverage, you can facilitate that through compensation, and either that compensation is tax preferred, similar to the way it's tax preferred in the group context, or you provide a tax credit for health insurance. Now, the last thing I'll say, I mean, I always kind of get maligned for being a part of the ACA, but during my time on finance, I did a significant amount of work on the tax credit for health insurance idea. Joe knows that, Tom, you know that. And that idea was then, provided to the McCain campaign, and they ran on it. So I'm a true believer
Brilliantly.
in...
Yeah, and they got
exactly.
slaughtered in the
That-
debate on the issue.
Believe me, I had a number of issues that were raised that were not well
Yes.
taken. But needless to say, a tax credit for health insurance...
And that
or
was a
let's say
highlighted Republican campaign.
Emerged-
Like we're doing this year, but anyway, all right.
a merged market, and you have the employers doing what they're doing. That's an excellent point.
Okay, fair enough. Before we go to the audience for questions, let me just point out that each of the speakers on this dais have, deeper, more detailed contributions on this front. Peter's work at Center of the American Experiment goes through in great detail in a longer paper the very dense legal and regulatory and tax history behind his proposals. Chris mentioned his paper and others as well on private exchanges. Mark did a recent paper at HICFO looking at the regulatory treatment, and Tebby's laying out the beginnings of what the Center for Health Transformation is doing in an earlier paper, which looked at the broader landscape. So I encourage all of you to take advantage of that deeper literature. We're just doing surface, highlighting the top of the line on this. With that in mind, though, let's see if we have any questions from the audience. And I'm seeing Carl in the back right there. If you could just give a quick identification before your question, Carl.
Yeah, Carl Polzer, and I'm started a project called the Center on Capital and Social Equity. Well, my question kind of relates back to when I worked for the nursing home industry and went to the White House with them 3 or 4 years ago, and it has to do with the penalties. There's a big piece of the ACA that hasn't been, it's long delayed, the teeth, the employer penalties. So it seems to me that they would apply, if when they are put in place, they would impact the part of the employer market that's probably the most sensitive to change behavior. In the case of the nursing home industry, you had an industry with a large percentage of the members with plans that would either they didn't offer coverage or they offered very substandard coverage. High labor, high percentage of their costs is labor. Therefore, to change that, you're going to have a great deal of cost increase. You're going to have to pass on to your consumers. But they're price takers. And interesting enough, most of their business comes from the government. They get paid for Medicaid, and they were stuck. So they're kind of a poster child for one of these parts of the market that would be hurt, ironically by the employer mandates. But anyhow, how's that going to play once it's implemented? And are we keeping track of how many fines they're collecting? Are they supposed to be doing it this year, or have they kicked it down the road again?
I can speak to it, but go ahead, please.
I was thinking, I hope you had...
Because I do a lot of employer compliance work in my practice, so I talk to a lot of folks about how to comply with the employer mandate. And to your point, it's been delayed, so therefore it's kind of been late to change behavior, if you want to characterize it that way. But I would say this: one, it is now fully in effect now that we're
Except for below 50.
it's
Which is a big
statute
hole.
says
Yeah,
below
I'm just saying,
50.
so-
Correct, but for those folks who the statute says you are subject to this,
Right.
which is 50 full-time equivalent employees and above, it is in full effect. Now, what's the enforcement going to be like to get those dollars? CBO makes their estimates, the administration makes its estimates, and it's a net revenue gain that they're suggesting. So the economists are suggesting that money's going to be coming in. But from an enforcement perspective, is the IRS really going to go out and knock on the door and bang on people's heads? You can argue that there's some funding issues, just the nature and the way the IRS operates is it's not that they have a huge wide net from an audit perspective. So I would question the enforcement side of it and question the economists' estimate as to how much revenue will come in. Having said that, though, the IRS is going to go out there, and the DOL is going to go out there in their normal course audits of employee benefit plans or for tax purposes, and they find stuff. And one of the stuff that they will find could be tripping up the employer mandate, and likely that's the revenue that the economists are suggesting will come on in. So the overall impact, I don't think will be significant from a revenue perspective. But from a behavioral perspective, I think it will be significant. That is, employers are holding on to coverage for a myriad of reasons. And one of the reasons actually is the employer mandate. And the employer mandate penalties are indexed to what I like to refer to as an indexed on steroids. It's not indexed to CPI. It's indexed to really premium increases over a period of years. So the penalty amount increases exponentially. And we're going to get to a point where folks argue, well, hey, paying the employer mandate penalty is much lower than paying for the cost of healthcare for employees. There probably won't be a break point because that penalty is going to be too high, and an employer is not going to say, okay, I'm going to get out. So it is going to have a behavioral impact on employers staying in the game.
Yeah, I think Chris raises some interesting points. First of all, in terms of this estimate of net revenue, whenever we talk about CBO estimates, and apologies to my friend Joe Antos, who used to do these estimates for CBO, it's really guesses, right? I mean, it's a nice word for guesses. I would agree that they would probably guess or estimate that there's some revenue from the employer mandate, but I wonder, and I think you called it revenue gain, but I wonder if there's actual societal gain, because I think in the short term, and this is before all that exponential indexing kicks in. In the short term, employers are going to look at this and say it's a lot cheaper to get out and pay the penalty than it is to provide health care. And there was an estimate in the Wall Street Journal a couple of years ago that said that AT&T spends about $2.2 billion a year on providing health care for their employees. If they paid the employer mandate, as originally conceived before the exponential indexing, they would spend about $600 million on the penalty. So that's a $1.6 billion delta. That's a big number. And shareholders are going to look at that number. Now, I happen to think that AT&T, for a variety of reasons, including the fact that they are in the regulatory crosshairs of the federal government and the fact that the Senate Commerce Committee regulates both them and them on their core business, but also on healthcare. So I think they're going to say, well, we're going to stay in, we're not going to take advantage of that $1.6 million delta. But let's look at a company 1,000 times smaller than AT&T. They spend $2.2 million on healthcare, and the employer mandate would only cost them $600,000. From that company's perspective, it is worth it to save the $1.6 million and drop out. So I could see a lot of smaller employees looking at the employer mandate and say, you know what, maybe we're going to just pay the penalty and not provide healthcare.
Yeah, I mean, mandate penalties work fine as a hypothetical warning shot. When they hurt too much, you see adjustment. Look at the experience with the individual mandate. How many people are exempted from that? What might have been the original dollar estimates. Any further questions in the audience? All right, well...
front.
Yeah, I was just going to say that. I was just looking... Yeah, go ahead.
My name is Li Yang. Thanks for your presentation. I would like to think about different angles. Among all these plans, and which will be affect the utilization of health services, whether they are more happier for the consumers, or the utilization of hospital services or doctor services or even pharmaceutical services. They prefer which plan and why, and whether there are more abuses.
Well, let me use that as an entree to think about wellness programs. So one of the things I think that's interesting and somewhat controversial in the employer market is particularly self-funded employers that bear the risk, worker productivity, sort of a kind paternalism for whatever reason, have invested a lot in employee wellness programs, and views differ on what people think about that. If there's a shift to more sort of individual choice of either in the non-group market or otherwise through an exchange, one of the questions is, are we going to lose that wellness component? And of course, one of the issues in the non-group market is the turnover effect, that any given carrier doesn't have a strong reason to invest in a person's health, 5 years from now if the average person changes every, 3 years. So I think that requires some more thought. I mean, I would like to see a more, I think there are distinct, health improvement, health care delivery value-based reasons to shift more towards individual choice of insurance. But I do worry about that sort of time horizon problem, and there are sort of creative solutions to that that I think one should revisit in terms of giving credits for insurers that invest in longer range outcomes, even for populations that they won't retain for a long time. So there's a new topic area to open up.
I'm not too worried about the shift to individual choice when it comes to utilization. In fact, I think that might be the solution moving forward. When we look at the current framework that we've been under for decades, where when we see employers go out there and they have their wellness programs and they try to develop these solutions, they generally don't put a real strong effort into it, and good ideas sometimes come up, but they don't flourish. And from my perspective, so much of that is the fact that there's not a large incentive on the part of the employer to really hammer at it, because ultimately they get to pass a lot of these costs off to their employees. And so there's a disconnect there. And I think when you look at the proliferation of high deductible health plans, I think that tells us a little something about that. As a consumer, I wouldn't want to buy a $6,000 deductible health plan, but my employer's telling me that's what I get. And in that framework, that type of health plan has serious impacts on utilization and how providers are paid. And I don't think it's consumer focused. I don't think it's consumer driven. I think it's driven by the fact that employers can offer that sort of health plan and pass something on to their employee. And if the employee had more choice in the matter, had more control over the health plan that they bought, I think you'd see a lot more innovative health plan designs that are there to meet that consumer's needs. And there's all sorts of ideas out there for tiered providers where you pay different levels for your insurance for different tiers of providers, for reference pricing, where if you choose if you opt for a certain type of, if you need a knee surgery, the insurance company says, hey, we'll pay this much. If you want to go to a different provider, you've got to pay more. We're seeing that somewhat in the provider marketplace, but it's really not taking off, and I don't have any faith that it's really going to take off in the provider or in the employer marketplace because it just hasn't taken off before. If we move to a system where all of these individuals that are right now covered by employers, all of a sudden we're in an individual choice framework where the individuals really started to tell insurance companies, no, this is what I want. Insurance companies would have to respond to that. And I think we would start to see some very interesting plan designs that would start solving these utilization issues that we have, and start solving these transparency issues, and start solving issues around electronic health records, and these sorts of things that we've been dealing with over the years.
Well, one of the hard things about predicting the future is only if you provide a date or a number. Within those limitations, Peter indicated a little bit where he's coming from. I'll give you a hedge in several directions. A rough 5 to 10 year time span, so you don't have to get caught on a fixed date. And you can go either way. What is more likely to happen as opposed to what should happen? So you've got a hedge on that front. But basically, we've always been playing with this mix of, is the market going to be more public or more private going ahead? And you know the path on that front. But even within the private side, is it going to be more weighted toward what we're comfortable with and have done before? The employer market is going to be about the same with some evolutions and try to perform better. Or are we going to see this evolution toward a more individualized marketplace? Within those wide open parameters, you can be more precise or less precise. I'll just take a general forecast on that. Not only what you would like to have happen, but what you think is more likely to happen within the, immense uncertainties. We're in the Bermuda Triangle this year in terms of politics and economics, where none of the navigational instruments are working. But get further out. Some things are inevitably going to happen, whether or not other things unfold. So I'm teeing it up on that front, which allows you either a minimal guess or a more precise set of preferences.
I'll go first. So in terms of what I would like to happen, I'd of course like to see the Tom Miller, Jim Capretto, Lon He-Chen consensus conservative health care plan go forward and see more free market.
You're not just saying that because I'm here, are you?
I would say that at another panel anywhere. But so I'd like to see some kind of conservative healthcare reform take place and improve the marketplace and do things that are sorely needed, like tort reform, for example, and rely more on health savings accounts and encourage people to purchase health insurance on their own. I don't see a path forward for that at this moment. I think we are going to muddle through for the next couple of years. And in terms of coming up with a Health Transformation Alliance, I was specifically told by the people who wanted to join something, I need something that's going to work no matter who wins this next election, whether it's Trump or it's Cruz or it's Clinton or it's Sanders. I need something that we as employers can do, even recognizing that Washington's going to be doing all this stupid stuff, and Peter made that good point before about you're constantly running into dumb federal laws or something like that, or federal regulations. And so they want to find something where they can avoid the pitfalls of federal laws and federal regulations to the extent possible, and do something that is, for the most part, left alone. I'll take Chris's point earlier that from a regulatory standpoint, they're mostly left alone, although from a cost standpoint, they're not left alone in the ACA. But that's a sunk cost. That's already built in. But given the environment we have, I think employers are going to continue to move forward on trying to do something different where they can move to this employer-facilitated model. The government is going to cover more and more people at higher cost and not be able to afford it. And the people who are neither in the government space nor in the large employer space, I think are going to have some challenges.
Okay. Peter, we'll go in sequence. You've sketched out a little bit about
So
where you'd
yeah,
like to go, but
I've definitely sketched out a little bit where I'd like to go, and I really like hearing that word employer facilitated model. I mean, that really does move in the direction that I think we need to go, because we're not going to see fundamental change our healthcare system needs unless large employers start changing how they deliver healthcare to their employees. And if it moves in that direction of employer facilitated model, especially in a direction where they're giving their employees choice over an individual type health policy where you create competition in an individual marketplace, I think that, to me, that's where we need to be moving. Whether we're going to get there anytime soon, I'm less optimistic. Employers have done a lot of things in the past, and that I like what I've been hearing from Tevi, and so I'm not confident that we're going to see dramatic change on that front. Hopeful. I mean, it's a good conversation, and it needs to happen. So we're going to continue having conversations, I guess, until it happens. And so I would like to. I am optimistic on that front a little bit. But then on the small employer side, one thing we haven't brought up is the fact that on the small employer side, we've seen a dramatic drop in the small employer marketplace in just the first year of the ACA. In Minnesota, we lost 50,000 people, 16% of that market in 1 year. And when you look at the national numbers based on CMS surveys, it's pretty similar. The national drop was pretty similar, not quite as dramatic, but if we see the small employer marketplace just drop off like that, I have serious concerns for where that part of the employer marketplace is heading. And it's then going to be heading in a direction where most people are more dependent on public health plans than private health plans. And unfortunately, right now, that's the direction I see us moving for that population of people, unless something changes. And that's why I think my policy right now to try to allow small employers to offer that defined contribution health plan is so important moving forward. It gives the employees the opportunity to stay in that private marketplace and have that sort of choice and control that we hope everyone can have.
Okay, Mark, in a world of ambiguity and uncertainty, you're golden for life. You can write some more studies.
Exactly.
What do you think
Yes.
is going to happen?
I don't. Whatever happens, I have something to say about it. After it happens. But I'm comfortable. Taking the charge you've given me. But I do think that there's sort of this natural sort of convergence around what I sort of still visualize as Eindhoven-style managed competition, which is more individual choice and more privatization. And it's sort of adding to this conversation about the employer versus non-group market. Let's remember what's happening with Medicare, which is sort of the rousing success of Medicare Advantage. And we're also seeing on the Medicaid side, not just Medicaid managed care, but the private option for Medicaid being implemented by a few states. And we want to see how well it works in those states. But you see movement in that direction there. So it seems to me that in the policy environment, we're really seeing this idea come into maturity. And I think in the political environment, it seems like there's an area of potential consensus around that. And so that seems to me to sort of be drawing things in towards that more sort of unified field aspect of what's going on now. Obviously, I don't think we're ever going to get there in a pure simplified way, but it seems likely to me that things will by fits and starts, continue to move in that direction.
Okay. Chris, Mark has his academic menu filled out. As a benefits attorney, hey, the more complex, the better, right? You're still in business. But what is both a more
I like how you're so
aspirational...
concerned about all of our careers.
Absolutely. It's well, you don't
Looking
want,
after us.
you don't want your jobs to get outsourced to China, but
right.
other people are taking care of that. Or cyborgs, which is the other alternative, which is more likely. What is both the optimistic side of we can do this, here's what we want to aspire to, and then the realistic, practical side to say, well, here's what it looks like is ahead on the table?
Yeah, if the ACA stays in place, I do see the employer-sponsored system remaining in place up until, as Tevi described, the hitting the wall happens, and that's in the 2025 to 2030 timeframe. So within the next 5 years, to your question, I think the employer-sponsored system will remain in place, and it will trudge along as it has in the past, and there will be some fights waged as it relates to the tax preference. Obviously, we've seen the fight as it relates to the Cadillac tax. I'm fully convinced that even if a Republican were to win the White House, and if a Democrat were to win the White House, irrespective of which party, that there will be a limitation on the tax preference in the law if and when the Cadillac tax is actually repealed. So we will always have a limitation on the tax preference. It just is, what is it going to look like? What's the new iteration as opposed to the Cadillac tax? So employer-sponsored system will continue. But to Peter's point, and to the point that I made, again, if the ACA sticks around, once the transitional policy ends, you're going to see more folks in the small group market drop off. And actually, Minnesota, I believe, is a state that did not adopt the transitional policy. And the numbers that Peter just spoke to is what I believe will happen in those states. And there's more of them than Minnesota that did adopt the transitional policy. So where can small group go? And I think that goes back to a merged type of market where you have a tax preference that is either similar to the current tax preference in group or a tax credit for health insurance. Pick a number, pick however you want to structure it, maybe similar to how Tevi, John, and Lonnie Chen and folks have structured it with the age-based variation and the tax credit. There's obviously a number of ways to do it, but that's what I see over the next 5 years.
Okay, utter disaster or faint hope just ahead. Sounds good to me. Joe, yes, you had a comment.
So, yeah, I'm a little slow with this comment. Before we get to policy nirvana, I'm kind of curious to know about the role of employers representing or misrepresenting the desires of their employees for the kinds of health coverage that they want. And what I'm thinking of is really insurance design. We've seen high deductible plans grow dramatically if you think in terms of percentages, but if you think in terms of numbers, kind of moderate growth. And partly that's because a high deductible plan, even with a generous health savings account, is a pretty intimidating product. You look at the California Exchange, which I think is the only one that's doing this. They're very regulatory, but one of their regulations is that they require all the plans to deal with the $6,000 deductible problem by saying that the deductible isn't taken all up front; it's spaced out over 12 months or something like that. So I'm a little puzzled about why employers haven't quite caught on to the idea that simple design may not be the best design, may not actually be attractive to their employees. Is it that insurance companies have simply not stepped up and said, here, we can do this a different way? Is it that the companies themselves haven't thought about it? What's going on there?
Sounds like it's directed to you.
Sounds like it's a question for me. So I would take issue with the idea of employers misrepresenting what employees want. I think they're just trying to accommodate what employees want and need within the budgetary realities that they face. And the benefits folks and the chief human resource officers folks that I talk to are acutely aware of employee concerns, complaints, quibbles about the plans because they hear it. I mean, they hear if Aunt Sadie can't get a certain type of treatment because the deductible or the benefit design, and they can't go to this pharmacy, they can't go to the doctor. They hear it. So I think they have a much better ear to the ground in terms of what employees want. In terms of why there's been a move towards high deductible plans. I mean, you know, you're an economist, you know that better than I do. I mean, it's shown that there's less money spent if there are deductibles, if there's skin in the game, and so I think that's why employees are designing the plans along those lines. Let's hear what your response is before I go on. You think from an economist standpoint that high deductible plans don't make sense?
No, not at all. That's not what I'm saying. What I'm saying is the structure. You want to get more people into those kinds of plans, but you have to make it less formidable for them to actually make that decision. As I say, I mean, there are lots of things that I don't particularly like about California's approach to the exchanges, but this is one where they seem to have, I think, a reasonable idea. How do you make what is fundamentally an unattractive product more attractive?
I've thought about this a lot. To your question, I think the larger employers actually are being creative and trying to figure out a way to help the employee deal with that cost-sharing burden.
Yeah.
Either through wellness, through other type of account-based plans to buy out that deductible, for example. But when you go down in the employer size, I don't think that the employers are being creative because they're busy doing everything else. They don't even want to be in the health insurance game. And to your point, I think the carriers have not gotten to the point to be creative yet. And really what California is doing and what HHS suggested in the recent 2017 Notice of Benefit and Payment Parameters of standardizing plans in the ACA exchanges is similar to what California is doing. I think that's all a function, or that movement is motivated by the ACA and the narrow network phenomenon that has cropped up over the past 3 years, as well as some other issues. So the query is, will that trickle into the group market and accomplish what you just suggested? And I'll add this last point. One problem, though, with what California is doing and may be impacting employers' decision is if you have first dollar coverage for services other than preventive services under a high deductible health plan, you render that person ineligible to contribute to an HSA. So that's the current tax law that's in place. Now, as we all know, we can change the laws. So in order to, well, we could try. You are correct. In order to address
Vote
that,
coming up in 5 years.
provide an exception for first dollar coverage for certain services and not render someone ineligible for an HSA contribution.
Yeah, I agree with Chris, and I agree with especially his point about the account-based plans. And the employers that I see are being creative about different types of plans. The HRA, FSA, they have all kinds of different names for them. So I think that does try to address the pain. But I also found in that study I mentioned earlier where it found that the cost per covered life is much higher in government plans than in private plans, and again, recognizing they're dealing with different populations, that in that same study we found that the employer plans have been much better at controlling costs and controlling cost growth over the last 10 years. So I think to that extent, I think the employers don't get sufficient credit for starting to do something right.
Mark made a point earlier about wellness and how wellness programs don't make so much sense when you might lose that person next year. And I think that kind of goes to your point here too, where changing the deductible structure and changing a lot of these other things for the better might not make as much sense to think too hard about that when you know you might lose it the next year. If you're a fully insured employer, they might just switch their plans the next year. And that's why I think the individual marketplace, if we were to go to this great vision for individuals choosing their own health insurance, you might go to that place where you have longer-term insurance contracts, where it makes more sense for insurance companies to all of a sudden to think about, well, maybe I'll have a deductible where there's one deductible based on the event. So if you get cancer, you'd pay one deductible based on that cancer event, and you never experience that deductible when you start getting ongoing treatment in the next year and the next year and the next year.
Well, we got some chickens and eggs as to which comes first, but we have a question coming up, and that'll probably be our last question. Could you move the microphone over, please? If you identify yourself.
Thank you, Gerald Chandler. Is there any difference in all the alternatives and possibilities that you've talked about on the coming physician shortage, which is growing and growing?
Yeah, I for at least what we've been talking about, plan design, we talked a little bit about utilization, and transparency is a part of that, which is something we didn't talk about. But when it comes to the physician shortage, if you want to refer to it that way, no. I mean, the ACA, I think, as dare I say it, has done a good job at least of breathing new life back into the primary care side of the physician industry, and a move away from specialists to a certain extent. But is it getting more folks into the field? I don't think so. So I don't know if the gentlemen here have a comment on that.
I think these ideas are fairly agnostic as to that set of issues. Yeah.
Yeah, I would agree with that. And with that, we would like to, the great thing about this speculation is it's non-falsifiable for at least the next year, but interesting beyond the horizon. So please thank our panelists and stay tuned to it.
Thank you, sir.
All right. You're my favorite moderator. I had never seen it. You said the first three documents.